All right, I think we have our answer.
Mhm.
Okay, I want to thank everybody for joining us today. It's Ben Marshall and Moshe Weinreb from the Chestnut River Business House. This is our series, which we like to call the Real Estate Shark Tank. Not that anyone is actually investing as we're here meeting, but it's thinking about it from the perspective of a Shark Tank investor. How do we look at deals? How do we analyze deals quickly, efficiently, and figure out what is the additional information that we need to get before investing in our projects? And from the perspective of a sponsor, um, how do you put together your project appropriately so you can present it to the investors and the investors can get out of it the information they need to make a well-informed decision? Today, we have with us John Rubino, and I'll give you a quick background on John in a second. Here we go. John Rubino is the co-founder, chief operating officer, and co-managing partner at JID Investments, LLC. He leads the firm's day-to-day operations, oversees underwriting and investor relations, and secures project funding. A veteran U.S. Naval aviator and holder of a BS in business administration from SUNY Maritime College and an MS from Embry-Riddle, John has a demonstrated track record of deploying capital into real estate and private equity deals. Under his leadership, JID Investments focuses on private money and equity investments with an objective of high yield returns at medium risk by backing residential, commercial, and mixed-use real estate projects, primarily in the Mid-Atlantic and South Atlantic markets. John, welcome, and we're happy to have you here today.
Thank you so much. It's an honor to be here with you, Benjamin and Moshe. I appreciate you having me, and I'm excited to talk with folks on board here.
Thanks, John. Before we get started, as always, we like to give a little bit of an ethical background to where we're starting. Today, I wanted to share a thought I had, and that actually comes from a section in a book called Pirkei Avot, and it says there was a group called the Anshe Knesset Hagadola, and Anshe Knesset Hagadola said at the end of their generation, they said to future generations, there are three things you can keep in mind in order to live a solid, strong life. It said, be deliberate in your judgment, raise up many students, and build fences around the law. So three items, but very important, especially when you're a sponsor looking at a deal. What does it mean to be deliberate in judgment? Well, sponsors must evaluate deals extremely carefully. They have to balance enthusiasm with rigor. Being slow to judgment in business means avoiding. Ooh, whoa, come back up here. Sorry, this is my smart camera just got not so smart. Not what it did. It just got hacked. Hold on one second. I'm going to change my camera as it turns itself around. I have never seen that happen before. All right, camera number 2. Sponsors, being slow to judgment in business means avoiding impulsive commitments, verifying assumptions, and stress testing the numbers before presenting them to investors. But what about rising up many students? When we're talking about being a sponsor, being an ethical sponsor, it means educating your investors, your partners, and your teams, not just transacting with them. Turning your investors, your partners, and teams into your students means creating a team around you that you can truly achieve great things with. Share knowledge, build capacity. And lastly, the Anshe Knesset Hagadola said, make a fence around the law. Build ethical safeguards beyond compliance. Ethical sponsors build compliance into their culture, not just their paperwork. They maintain clear policies on conflicts of interest, transparency, and disclosure, even when the law might allow looser behavior. The fence, in modern business terms, is an internal standard higher than the minimum regulatory threshold. So it goes all the way back over 2,000 years to what the Anshe Knesset Hagadola said. In order to make us better people, we can take that into business today. We can take it into our own companies. We can take it into our own sponsorships. And tonight's meeting is an opportunity to do exactly that, continue on building something great together. John, thank you very much for joining us here today, and I look
Yeah.
forward to hearing your presentation.
Well, thanks, Ben. I really appreciate it. That's some very wise words that you just shared, and I think it's spot on with how you look at deals and how you look at folks you want to work with and partner with. I'm a big fan of making sure that you know who you're talking to, who you're working with, and building a fantastic partnership with those groups. So, can everybody see my screen here? Ben, can you see my screen?
Looks great.
Okay, great. And so I'm going to use this presentation mainly for educational purposes, but this is an actual deal we're actually raising on right now. And I want to just talk to you from the mindset that this is for just how we put these projects together. There's a lot more involved in this outside of what you're going to see tonight, which with regards to putting the deal together, finding the property, putting all of the money together. And for us in our company, JD Investments, we are really bringing about 5 to 7% of the total amount of money that's needed for a project for these sponsors, these developers to build. So we're a really small piece, but we still have to have mindset of knowing what's going on in the entire project, from who the general contractor is, who the key players are, how's all the money being brought into the deal from the bank to the larger institutional equity. So I'm going to go through this, but I want you to just keep in your mind how these deals are put together and what you should be looking for when you go through an investment deck or a pitch like this, and just kind of making sure that you're seeing the things you need to see from this presentation. Benjamin, I also provide coaching, and I have a program that I educate as well. So I walk through this with the mindset of looking at it maybe as a new investor, or maybe someone that is a little bit seasoned, but at the same time, just knowing what to expect, how to see it, and what's the information that you want to pull from it, big picture. This building here in the center, this is the property. It's called the Indy. It's located in Midtown Atlanta. It's 91 units that was originally supposed to be condos. But back in 2020, we got hit with a global pandemic called COVID, and that changed things immensely. So we had to go back and redo the structure and scope to make it 91 apartments. And so that definitely changed the scope. We had to make some major changes, but at the end of the day, it's a beautiful building. It has about 15,000 square feet of retail space, parking, and a fantastic location. You can see downtown Atlanta in the background. So I will go ahead and kick it off and try to move quickly here. So bottom line up front for this deal, we are taking out a portion of the capital stack that makes up the capital for the project. And so we have the opportunity to what's called recapitalize out about $5.75 to $6 million of capital that's in the deal. And we're looking to take that capital we bring in to recapitalize those funds. And in turn, we are going to get the accrued interest for basically just bringing in the money and taking out those investors. And we're also going to get a project level return of about 15% going forward over a term of about 15 to 24 months. Okay. This building's already finished. It's about 93% occupied with tenants on the residential side, and on the retail side, we're starting to bring in retail tenants to occupy that space. The as-is value of the property right now is about $63 million, with the retail space fully occupied and seeing some compression in cap rates. You should be somewhere between $70 to $75 million, which is what we're shooting for. Investors on this project for our company are going to make what we typically shoot for about a 15 to 20% IRR. And what that's made up of is the waterfall we have, which we'll talk more about later. But we offer a preferred return, a profit split with a return of capital, and then we typically offer profits 60-40, 70-30 in favor of the investors. Okay. So in this project, we're looking to bring in about $5.75 to $6 million to take out that level of capital. Again, this is just for informational purposes. It is a live deal, but the big thing, again, is like taking away the information we share. We're not being solicitory by any means on this. If you see anything you like or you're interested in, you can reach out to Benjamin and Moshe. We can talk more, but again, education is our primary. So this is typically what you'll see on a project, the executive overview of why this is a good deal. And we'll have these slides for you. But at the end of the day, we've got a very experienced sponsor that's got a $700 million development company. We've partnered with them since 2013. So we know this sponsor very well. We've worked well with them and done very well. We've got a great partnership. We have a strong location in Midtown Atlanta. The demographics are fantastic. The income is great. We have a lot of jobs, a lot of employment, a lot of Fortune 500 companies. There is some risk from the mindset that we have vacant retail space, but the fact that the building's already there, it's constructed, and it's 93% occupied on the residential side, we feel that the risk is well mitigated. And then, of course, we have some very good returns on this project, which we'll show you here in a bit, with a very, very generous waterfall. So this is what you should see as well on a deck, an executive summary. I won't go through this too much, but this is how we describe the opportunity, where it's located, the size, the current state of the investment, and where the property kind of sits right now in this phase of our investment. We also want to provide some economic information and data from the local area, which we do in the investment highlight section. And then on the right side, you can see our financial summary, which takes us from the location, the name of the project, the sponsor, all the way down to the amount of money that we're looking to raise from each of our investors. So JID has 200 investors. Our investors are either accredited or sophisticated. And so we typically raise on a minimum of about $25,000 to $50,000 a project. So for this investment, we're looking for a minimum investment of $40,000 per investment. And people come in for more than that, but that's the minimum we have allotted for this project towards that 5.75 collective total raise. And then you can see the timeline, the internal rate of return on the preferred return, 12%, the targeted return about 16.8 to 27%, with an equity multiple, and then dollar for dollar in and dollar for dollar out on the project. The next section really focuses more on the demographics, and this is something you should see on every deck you see. How's the demographics? What's attracting people to the location? You can see on there Atlanta ranks in the top 10, top 25 in various categories. You want to take a look at what the occupancies are for the same type of product in the market. So this is really demographic information that kind of gives you everything from the tip of the iceberg down. And then you have your top 10 businesses with employers on the right-hand side. I'm sure you recognize pretty much all, if not a good handful of those. This is a market overview, which we usually use to show what's the local amenities, what's nearby. This project is located right next to a 20-mile walkway public area that's open to shopping, retail space, restaurants, and all kinds of living amenities right next door to where we are. So it's a fantastic area. The name of that 20-mile walkway is called the Atlanta Beltline. So if you look up the Atlanta Beltline, you'll see what I'm talking about. But this just gives you a snapshot of the area overall. Again, some population. It's always about seeing increasing in population. You want to see more people coming and migration. That's going to also help. And then at the bottom, you can see the average incomes. That's a very nice income to have in this type of area. So you know you have like a higher retail type tenant, especially a new product, which is typically going to be a little higher on the rents. This is what we do side by side to take our property at the top, the Indy, and then we look at our nearest comps, and then we do a rack and stack of looking at the property we have, as well as our comps, our competitive market analysis type properties, and show apples to apples where we rack and stack. So we have about 6 properties here that we've paired up with ours, and it goes through each section from total year it was built, the bedroom and bath, square footage, price per square foot on the rents, the total rents, and pictures of the comps on the bottom there. A little bit of an eye chart here, but this just gives you an idea of what our current balance sheet looks like. And not balance sheet, I should say, a rent roll, our income statement. So I've got the income statement here that overlooks from June 25 back to July of 24. So you can see how the property's been performing. You can see the income in the middle there is growing nicely to get our net operating income right now at about $204,000, which started out at $57,000 as we started ramping up and bringing on more tenants. Again, as we bring on retail tenants, we'll see that number go up even more. Our goal right now is to get about 275 to 325 in hundreds of thousands there to hit our net operating income. Here's some comps we use to show cap rates. Cap rates are very important because with the cap rates, you can determine the valuation of your project. So Cap rates with your net operating income will give you a total valuation. So right now we're targeting about 4.75% on the cap rates. And you can see we are right in that sweet spot, which is at the bottom, about 4.57%. These are some high-rise cap rates, which are even better, a little bit more of a pristine type property. But again, we are right in that sweet spot from where we anticipate our cap rates being for an exit in the next 15 to 24 months. I've got one there that hits our numbers very closely, you can see. And those down at the bottom are a little bit of outliers there as well. So we did a valuation spread on this, and that's where we're targeting this property to sell for right now, between 67.5 million to 72.5 million. Keep those numbers in your back pocket, because when I show you the capital stack, you'll see where those fare up. Here's our sourcing. So the total sourcing for the deal right now is 60,850,000. We are basically coming in we're basically coming in to take this member loan class out, which is at 6.25. We're going to bring in 5.75. So there'll be a little bit of member loans that remain, but we'll be taking out about 92% of those member loans. You can see where that stack is from where we are currently and where we anticipate to go with our money coming in. This is where it gets fun. You can see on the left-hand side, the capital stack, which is basically our bank lender at the bottom in the green. We have the mezzanine debt on the left-hand side as the $13 million mezzanine debt lender right now. They're kind of a junior lender. We have member loans, which again came in to help offset increases to the interest rates, as well as help to facilitate the need for capital. And then you have an LP GP common equity group at the top, about $9 million there. And then on the right-hand side is what we're looking to do to bring in our level of capital, which is going to basically dilute this member loan class on the left side from 7.915 to 7.195, with our company coming in now as preferred equity, taking out a debt piece, which is very interesting because from a tax perspective, coming in now as equity over debt, we can capture our gains as long-term capital gains if it's over a 12-month period beyond. Okay, I know I'm running through this quickly, but I want to make sure we get to the meat and potatoes, which is this really here. And we'll go back to this probably a little bit later, but this is our waterfall. Pretty straightforward. We have a 12% preferred return, which is very, very generous. But again, given the level of risk, we feel that that warrants. We then offer on our second piece, and I'm looking at the right-hand side here, a return of investment capital. We then get a JIDI management catch-up, which basically means our management team gets a return on those profits that equate to the 12% preferred return. So basically we're saying, hey, we paid you out a 12% return. We've got you back your money. We're going to take a little bit of profit. And then the remaining profits will be 60-40 split between the investors in their favor. So 60% investor, 40% management piece, which is us. Here's the recap here on the bottom in the blue in the box. 5.75 is our target, 15 to 24 month term. So with the 12% preferred return at the top, the 60-40 split, we're looking at a 16.8 to 26.9% IRR. This is dollar in, dollar out, where the preferred return here is 12%. You can see it in the orange, with the profit split at 60-40 over the 15 to 24 months. There's your total profit, which includes your preferred return and your total profits for 15 months to 24 months. And again, that's for illustration purposes only. So in summary, again, we're taking out $5.75 million of debt loans. We're going to collect the accrued interest, which is at $1.5 million for the 2 years. The 5.75 has been in. We're also getting a 15% IRR per year return on top of our money going forward. The current value as is ensures protections on the investment, thus mitigating downside risk. Higher priority position inside the capital stack now is preferred equity. Our investors we're going to hit our sweet spot, which is typically 15 to 20%. What's nice about this is those returns we usually advertise when there's just dirt, but now you have a beautiful property here that's already existing with 92% occupancy. And we have a continued valuation of that retail space, which should add about $8 to $10 million to our bottom line. So I'm going to take a pause there, Ben. Hopefully I got through that enough time. I think I did. I'll go ahead and hold off for any questions, or if you want to take it from there, we can go back to any slides you'd like to look at.
Absolutely. Thank you very much. Thanks for being respectful of the time. And what I really want to dig in today's episode is on your waterfall. So do you want to pull up
Sure.
the waterfall slide?
Yeah, absolutely. Be happy to. Yep. That's slide 16 of our deck. Yep. There we go.
The goal here is to understand if I'm an investor, what am I excited about this waterfall? Let me really understand it so it helps me figure out how risky my investment is in the overall deal. So the
Hmm.
first step in the waterfall, in other words, the first way that money comes out of the deal is going to be the investor's 12% preferred return. Talk to me about that. Why should I be excited about that? Is that good? Is that bad? How does it compare to what else you're seeing in the marketplace?
Yeah, so I mean, for a typical value add type project, a multifamily existing that's paying out quarterly cash flow or semi-annual cash flow, preferred returns could be as low as 6%, maybe as high as 8%. And what the preferred return really is it's basically that percentage that is paid out first and foremost to the investors. And so any money that comes out of this deal, whether it's year over year, it's quarterly, it's semi-annually, for our deal, it's projected at 15 to 24 months. Any dollars that come out of this will go towards that preferred return. And if that preferred return goes beyond 12 months, it's accruing and it's building and compounding so that it would go forward. And so at the point when it starts to distribute capital, we go back and we catch up on that 12% from the time the investment started with the money coming in to the time the first dollars come out of the project. So the reason why it's really nice here is because our 12% preferred return is a lot higher because of the level of risk and where we sit in the capital stack. And what's attractive about this is that 12% preferred return is usually what we pay on a development deal when we're just getting started. So you have to go through permitting and planning and development and entitlements, whereas now you have a fully existing property, 93% occupied. So on a property like that, you're probably seeing about a 6 to 8% preferred return.
So if you're an investor looking at this and you're talking to the sponsor, your next question should be, hey, John, that's really interesting. Let's talk about that capital stack. What do you mean by it being risky? Why is my 12?
Sure.
And
Yeah.
I say this because one of the things you want your investors to know is you want them to understand the level of risk they're getting involved in. You really want them to understand why, if you can go out to the bank and get a home equity line of credit, you can spend 7% on that today. Why is this investor willing to pay out, even before he gets a penny, 12% right off the bat to all of his investors?
Yeah, great question. Like you said, and I have this on the right hand side, you said it perfectly, is the lower you are at the bottom of the base or the foundational portion of the capital stack, the less risk you have, the more security you have. So the lower returns you get, right? So the bank is going to always get typically the lower end of the interest. They're going to be getting paid obviously monthly, but they're usually going to see, pre-COVID 4%, post-COVID 6.25%, maybe 7% on the interest. So they have the largest chunk of money in the deal, but they get the lowest payout in interest, right? So they've got that security position. They have the property in case something goes bad. Sponsors typically will have a personal guarantee on the debt in case the property doesn't cover it. And so there's a lot of security there for the senior debt. And then as you move up towards the top, risk gets a little higher. And so the returns get a little bit better. So that mezzanine debt, which is typically considered junior debt, will probably be seeing about a 10% to 12% return. And they're sitting in a second position. So anything that the debt covers up to, anything beyond that, where after the debt is covered with its full principal, the mezzanine debt would step in and take the next chunk of money that's available. Okay. And
So,
then,
John,
yep, I'll take a
looking at
pause.
your
Go ahead.
asterisks, so we understand the asterisks on the bottom are interesting. They give us really good information
Yeah.
here. The
Yeah.
first thing I want to say is you have this measured, the values you've got on the right side, is that based on a 15-month exit or a 24-month exit?
The numbers are inclusive of the principal and the interest and equity to repay to get us to a 0-0 in and out. So there's no returns on the equity in this description. It does include the member loan interest. It does include the mezzanine debt principal and interest, and it
That's
includes, yeah,
I'm sorry,
go ahead.
the debt and interest that will be current as of the date we start this investment, right?
No, actually, it would be at the 24-month point when we
At the
exit.
24. Okay, so 36.6 million that we're looking on the debt side is the payoff amount at 24 months.
That's correct. Yes, on the
Okay.
principal. Right. And then
Okay.
the mezzanine debt's at $9 million from our previous slide, which is the principal plus $4 million of they're getting a preferred return on their money plus a little bit of profit split. So that gets us to $13 million in
We're doing
24 months.
we're doing math in our head right now. We're
Yeah,
saying
yeah.
we've got
I have
we've
the
got
math. I can show it to you. Yeah,
we got $60
absolutely.
million of
That's
it
right.
sells for $60 million. So the first 36.6 is going to go to the senior debt at New York Life.
Yep.
Next 13 million is going to go to the mezz debt at Court Capital. We'll call that $50 million right there. So now we've got $10 million left.
Mm-hmm.
What happens to the $10 million? The first 665,000 of that goes to pay off the rest of these member loans.
That's correct. It'll pay off the rest of the member loans, and then whatever remains is going to go to the LPGP common equity piece. So if I go to the previous slide.
It's going to go to the pref equity next, right? Before the GPLP.
Well, so in the existing right here on the top, you got New York Life at 36.6. We've got the second mortgage at $9 million for core 10. Right on the next slide, we show it as 13, which includes the $4 million. We've got the member loan class at 6.25 million plus their interest, which gets them to 7.915. And then we have the $9 million of general LP equity at the bottom, at the top. So that's on this side right here. So right now, the property is worth about 62 to 63 million dollars. Okay, so we've got enough to cover everything with a little bit of a gap. I'd say about $3 million of a gap for the LPJP common equity. So they would be that at the most risk, being at the top, but everyone else below them would be fully covered at a $63 million sale.
So if somebody comes to you on the same deal and offers you an LP position with I'm going to give you 15% return as an LP position versus the 15% as the pref equity position, right? Like, which is sort of equivalent to what we're saying here is you think 15% return is 15% return, but what we're showing is that no way, no how. The pref equity
because you're sitting at the lower position.
Paid out first.
That's right.
Only what's left over is going to go into that LP. And what you're saying also, John, right now is that currently the guys in the LP position are going to take a $3 million bath.
Right now they would. Right now they would. So I'm going to throw a curveball at you. My company has $4.5 million of that $9 million from when we originally came in back in 2018. Obviously I have some interest in both the LPGP and now coming in for the preferred equity piece. So
what's your strategy to rescue the LP?
Yeah. So first and foremost, I want to make it first and foremost, I have to make sure that per my operating agreement, anything I'm doing with this new raise for the pref equity doesn't put the LPGP in a position to be at risk. And given the current valuation at 63 million with $8 million of retail space still on the table, that gets us to $72 million, right? So at that number, we're covering this entire stack. It actually comes out to about $66.5 million to cover everything on the right-hand side here. And that includes the $9 million of return of equity to my LPGP position, okay? So that's about $66.5 million. But if I sell it for 73 million, I'm actually getting that LPGP some profits, which is what I want to do. I want to try to get my investors in that LPGP position about a 12 to 15% return since they've been in the deal since 2018.
So now my next question goes to I think what you just sort of implicitly said here is that the waterfall is both about the position in the waterfall and what the total value of the amount of money that has to fall through the waterfall. So
That's correct.
can we go back to that cap rate slide that we talked about here?
Sure. So here's the cap rates for comparables. I got about 24 on there. Is that the one you want to look at?
Yeah, it's great. And it's
Mhm.
really sort of a generic thing. The cap rates really, what the way we calculate cap rates, the way we calculate the sales price is we take the NOI, the net operating income, and we divide it, sorry, by the cap rate.
The cap
Now,
rate.
we don't see the NOI on this slide, but
Yeah,
um, it's the operating income of a property divided by the cap rate. That gives us our sales price of, and so that's how you go backwards from the sales price to the cap rate. What it tells you is that um, a small change in the cap rate will have a massive change in the expected sales price.
that's
So,
correct. Yep.
so the importance of having an ethical sponsor is huge because it's
Mhm.
very, very easy to shade your cap rate one direction or the other direction. And you obviously, very few people are going to try to shade it against them. They're not going to shade it up high, but you have to really make sure that if someone shows current marketplace is that cap rates have been expanding. So at least in Boston, which is where we're based, we've seen expansion of cap rates from 2%, 2.5%, all the way out to 4%, even 4.5%. And then as you go out further out of Boston, you can get it up into the sixes. It's a very interesting time because cap rates had been so small, so low, meaning that valuations were so high that as the cap rate expanded, the value of this very same property with the same cash flow on it uh, collapsed on itself. So it's also giving us a lot of really interesting investment opportunities. So
Yeah,
cap rates need to be really sensitive to. Let's go back to the waterfall again.
sure. And to your point, that's absolutely right. The cap rate, if you see here, the residential cap rate at a 4.4, and our net operating income, which I think I had at about 3 million, gets us to about a $67.5 million exit. Obviously, we want to try to get it a little closer to 70 to 72. It's aggressive, but I think if we can bump up NOI, we have some concessions we burn off. I think it gets us closer to that 72 to $75 million number.
I mean, the trends are in your favor with the Fed reducing rates and everything.
Mm-hmm.
I think
Yep,
everybody expects the next 12 to 24 months to see cap rates compress down a little bit again. Um,
correct. I agree.
so it's not, yeah, your arguments are really strong. All right, great. So that's the preferred return. Now, why would you have to show return of investment capital? What are you saying there? On that
Yeah, I
second
mean,
one.
we want to make sure that people understand that after we get them their 12% return of capital or return of investment on their preferred return, we want to be able to get them back their money. We want to be able to say, okay, we've got you caught up. We've got you 12% all the way up through either 15 months, 24 months. The next tranche is to get you back your money. So now the investors not only, yep,
So John, I'm an investor. I put my money in. I got a 12%, not 12% return on my money, but 12% annualized IRR. So it's a compounding 12%. If it's over
correct,
24 months, it's not 24%. It's more like a 28% number. Um,
26.9. Yep.
26.9%. There it is right there.
Yeah, you got it.
So I've got my 27% return on my money after 2 years. I got my money back. I'm in my pocket, and there's no more money left. What happens to JID? Did you guys make money on this deal?
We don't. The only way we make money on that deal is we get a 12% return on the investment capital we've brought into the deal because we invest on every one of our projects.
Okay, so yeah, so you get it alongside with us.
That's
The same.
it.
Okay,
That's a great
so
point.
you've the only money you've made on it is just like the rest of us, but you haven't been paid for all this hard work you put into this. Do you have
Mhm.
any fees in this deal that maybe would get you covered?
Yeah, if you look at the bottom left here, the last blue box on the left, it says JIDM management will assess a 1.5% asset management fee independent of advertised JIDI investor returns. So that's basically a bill we send to the sponsor that's paid out from their pocket outside of the advertised returns on the deal.
Now, why did you choose 1.5% for your asset management fee? And why is there only one fee here? Sometimes you see a lot of fees on it too.
Yeah, I mean, so the sponsor's obviously going to charge their fees. You may have a construction management fee. There may be an asset management fee they build in. We just build that fee in. We kept it below 2% just because most of the time you'll see fees at around 2%. So we wanted to be competitive. We wanted to make sure folks understand that we're not looking to make all of our money on the front end of the deal. Our goal is to walk this through and make sure that we're all successful, and that we'll take our promote after you get your 12% per annum, compounded, caught up return with your capital before we see any money. So that 1.5% fee is really just to keep the lights on for our business.
So when you are investing pref equity in with a sponsor, what are you looking at? The sponsor is going to have his own waterfall, his or her own waterfall. Sorry about that.
Yeah.
What sort of fees are you looking for the sponsor? I mean, if they're building a project, they're doing a lot more than just putting money into it.
Yeah. If I see too many fees, it's a concern as long as they're lower. But I typically don't want to see more than two or three fees, maybe an asset management fee, an acquisition fee, and that's really it. If I see more than that and they're the 2 to 3% range, get a little suspect. I'll ask them to explain to me how they compute those fees. And then the other thing, which is very important, is how are they paying themselves those fees? Are they paid all up front? Are they paid out as a milestone? Because that's going to tell me how hard they're going to work. If they're getting all their fees up front, what's the real motivation if something bad happens on the project, if they're going to make sure that they follow through, find alternative options to make sure we come out of the deal with no major risk.
Got it. Yeah, fees are really, really important. When you're looking at a waterfall, you always have to concentrate on what's going on with the fee structure because the fees happen before the waterfall. So it doesn't
That's
matter
correct.
how the waterfall looks. If all the money is soaked up in the fees, there's no water for you to collect in that waterfall. All right. So what is the JID Inc. management catch up?
Yeah, so what we typically do is we run a calculation to show, hey, if the investors got caught up, they got their 12%, we got them back their money, what do we need to make in order to basically equate to apples on the 12% preferred return? So what we typically do is we say, okay, if it's a 60-40 split or 70-30 split, depending on what we choose, that is also the determinant of what the ownership is for the investment piece in our entity. So when we stand up this entity as an investment entity to come in to invest alongside the sponsor, our entity is made up of both the investors and JID management. So if it's a 60-40 split, we have the investors as a 60% owner or manager, not manager, I'm sorry, owner or LP investor. And then we have JID Investments as a 40% GP member with decision-making power for our entity. So at that 60-40 split, they also have 60% non-voting management ownership, not management, say management. So what we end up doing is we say, okay, if the investors got, let's say 12% over 2 years, 24% or 26.9, what is 12%? What do we make per year if they're making 12%? They got paid 12% year one, 12% year two. What do we have to make in turn? So we take that 12%, we divide it by the percent ownership that the investors have. So if you divide 12 divided by 60%, you come up with 20%. Okay. So the investors are getting 12 in order for us to basically be on par and caught up with their 12%. We would get the next 8% inside of that 20% payout, if that makes sense. So ideally, we want to make more than that 20% overall. But in order for us to hit the 12% preferred return, the return of capital, and for JID management to get caught up, we would have to make a 20% return per year on the project.
That was pretty.
Yeah, and I could show you the math on that, but that's the best way to show it. The nice part about our private placements is we actually show examples with numbers on how we compute that, so folks can calculate that with us.
as an investor, if you start glazing over as an investor, it's important to turn to the sponsor and say, look, words are one thing, but let's go through the Excel model. You need to be able to get into it and do it yourself so you understand where the money's going. Because if you wait until after the sponsor is writing the checks and they think they've explained everything to you properly, even the best meaning sponsor, you can still get into a fight with them because you don't understand. You think you're about to get something that you're not getting, and they think they've explained it well enough to you. So this is the
Right.
time to have the conversation. Um,
Absolutely. I agree.
so at this point in a presentation like this, I would turn to John and say, let's just, for me, I'm very comfortable in Excel. Let's dig into the Excel model. I really
Yeah.
want to understand how this is doing. And then I would stress test it a little bit of little high and low. And yeah, so John, thank you so much
Yeah, my pleasure.
before we wrap it up, I want to just open up the mic to anybody else who's got a question. If anyone has something they want to ask right now, on waterfalls, specifically on waterfalls, I don't want to dig into the deal itself because the deal itself would be more of a question that you could have offline with John individually.
Yes, absolutely.
All right, there's silence in the room.
Hi,
Um,
Benjamin. James with a question. First, I want to thank you for organizing this, you and Moshe and John, for this really interesting deal. I guess if
Yeah,
we could go back
absolutely.
to that last slide, and maybe this is
Sure.
just me being silly with a formatting thing, but I guess I'm having a hard time without having John verbally explaining it, identifying the sequence of the payouts to the right there because it's kind of, is it left to right, is it bottom to top, like just in terms of preference, if you could just sort of describe why you chose to present it this way, and Benjamin, maybe you could say if you think this is a sort of standard way of presenting that.
James, this is like the hardest when you're trying to present a waterfall to people and to investors. It's so difficult to come up with a visual way for people to see it. Um, I once found a very good Excel sheet that actually shows it literally flowing down, and it worked out very nicely. But other than that one, like this is hard. So I think it's a great question, something that
It is.
John should walk through.
Yeah, absolutely. So, James, one of the things I do as an investor, I'll take my owner hat off of the business, but as an investor, is I have an investor worksheet that I keep for myself. And so, what I do is I build on an Excel spreadsheet basically each tier of the waterfall, right? And I do it year over year. And what I do is I build it as a projection first. Okay. So, if everything goes as planned, and let's say there's a distribution in year one, this is what I should get, right? And then in year two, this is what I should get. And if it's continuing on, but for this deal, year one and year two, let's say, I'm going to build out how every dollar comes out of this, what I should get. And then what I end up doing is that if I don't get paid in year one, right? And then I run a scenario to show, well, what happens if I don't get paid anything in year one? That then would get captured as a compounded return in year two. And I do the same thing in year two now with the model of showing what that would look like with the added compounded return from year one. Okay, so I do that for myself. So I do the 12%. Then I just return my money, great. But then the split is going to be regardless of what my preferred return is. My split's going to be based on advertised return from a dollar perspective. So in this deal, if we hit all our numbers, I work backwards and I show a 16 to 26.9% return. I've got to show how that's made up from the 12% and then the split. So kind of work it, reverse engineer it to show
John,
what I should be getting. Yeah, go ahead.
I think he's asking a slightly different question. I think the question he's asking is he's looking at the slide and he's trying to understand the order of operations within the waterfall itself.
Exactly.
So,
Okay.
so
Okay.
if I were doing the slide slightly differently, I would number this. I would write like step one here,
Mm-hmm.
and then I would even put something over here saying who it's going to, right? I would say investors get 12% return preferred return. And then I would also clarify on this side of it whether or not it was a simple interest or it was accrued interest. And then I
Mm-hmm.
would have step two, return of investment capital. And I would also clarify goes to investors. And what's important is that it's in chronological order, and you sort of, sorry, like my annotations are ugly,
No,
but
that's fine.
but just try as best you can to go from a um, a visual into something that sort of reads the way it goes, where the money, whatever money is left over in the pot, first goes to the first amount of money goes to the investor. It's very, very powerful. Preferred returns are a really, really important aspect if you're an investor in terms of protecting your downside protection. And
Mhm.
you you know, a lot of times you think I'm getting a better deal if I get into a project where someone says to me, we'll split the profits, I'll take 40%, you take 60%. And you think, wow, I get 60% of the profits. That's awesome. Versus a 12% preferred return, that doesn't make any sense. But
Mhm.
in point of case, you make much more money at much lower risk. I should The first step in the waterfall is a preferred return that goes to you as the investor. You will hit many more doubles and triples, and you will not strike out. And if you can go through investments and knowing that you're not striking out deal after deal after deal, and you're doing well, you're at least not doing badly on every deal that you get into, your wealth will continue to grow much faster than any other time you're investing. So not losing your money is a really big deal when it comes to
Oh
investing.
yeah,
And preferred returns are a great way to make sure you do not lose your money.
Thank you for the
absolutely. Yeah,
thank you
thanks,
for
James. Good question.
thank you for clarifying my question, Benjamin. I'm sure it's I'm not as expert as you all are, but I understood I understood there was something I wasn't quite getting. So thanks for the explanation. And just one quick comment for John. I just want to thank you for your service, even though you're a
Thank
naval
you.
aviator. I flew C-130s for 10 years,
Oh, very nice.
and we can talk offline.
Thank you for your service as well, sir. Yeah, and I hope you feel better. No, I think that's a great point. We typically have this slide for the investors on the right-hand side, but I agree with you. There are definitely some tweaks we can make just to give it a little more extra. Yeah.
Any questions? CD, you have your microphone on. Did you have any questions? No? Okay. Great. Guys, it is almost 7 o'clock. My wife gets angry at me. Actually, she's upset with me already. But as of right now, let's wrap this up. It was great. I hope you guys have a chance to join us for some of the other ones. We keep taking these projects apart slide by slide, so everyone has a chance to understand the right questions to ask. We feel practice and for the rest of us to really think about what it takes to analyze an investment. So thank you for your time tonight, and I hope you join us on other weeks. John, you were incredible. Really, really fantastic.
No, this is great. I enjoyed it. Thanks everybody for letting me present. And yeah, come on out. These are great. It's a good way to do this.
All right. Thanks, John. We'll see you later. Good night, everybody.
Thanks, Ben. I'll stay on if you want for a few here. Good night, Moshe. Thank you.